Welcome to this Delta Debrief presentation on ServiceNow's Q2 2025 financial results. In this session, we will review notable changes in the company's financial metrics, operational strategy, and industry positioning using publicly available disclosures. This presentation is for informational purposes only and does not constitute financial advice. All commentary is based on publicly available data from SEC filings and earnings communications. Please perform your own due diligence before making any investment decisions. Here's a quick overview of the topics we'll cover in this debrief. We'll examine 7 key areas: financial snapshot, segment performance, management commentary, initiatives and strategies, peer comparison, risks and challenges, and finally, key takeaways. Let's begin with the financials. Q2 2025 revenue was $3.22 billion, up 22% year over year. This increase was primarily driven by upselling into large enterprise accounts and broader adoption of vertical AI offerings. The full-year growth trend reflects more effective land and expand execution, particularly across IT service management, human resources, and customer service modules. Net income for the quarter reached $385 million, representing a 47% increase from the prior year quarter. This growth resulted from both higher revenue and improved operating cost leverage. Gross profit increased by 20% year over year, while operating expense growth, especially in general and administrative and sales and marketing, was more contained. Operating margin expanded to 11.1% in Q2, compared to 9.1% a year ago. This occurred despite continued investment in stock-based compensation and research and development. The margin expansion suggests improved productivity within the go-to-market organization and potential benefits from internal automation efforts. Cash and short-term investments totaled $6.13 billion, about $880 million higher than Q2 of last year. This increase was driven by strong free cash flow from upfront subscription billings and improved receivables collection. Investing outflows also moderated relative to inflows. Total debt remained flat at $1.5 billion. The 2030 notes, with a 1.4% coupon, remain the only debt outstanding. Net cash position increased further due to internal cash generation. Now let's take a closer look at how different business segments performed during the quarter. Subscription revenue for Q2 was $3.11 billion, growing 22% year over year. Professional services contributed $102 million, which represents a 20% increase. The company attributes this growth to expanded customer adoption across IT, HR, and customer service workflows. Integration of generative AI features like Now Assist encouraged module expansion and seat growth within existing accounts. Europe and Asia Pacific regions recorded double-digit revenue growth, supported by stronger partner ecosystems and wins in regulated verticals. With that context in mind, let's review what management communicated in their commentary this quarter. Management described ServiceNow as an enterprise coordination platform, integrating artificial intelligence throughout its product suite. The company reported $23.9 billion in remaining performance obligations. This figure was highlighted by the CFO as an indicator of strong forward revenue visibility. Leadership also noted plans to continue investing in AI and mergers and acquisitions, while improving operating efficiency through automation. Next, we'll examine the company's latest strategic initiatives and how they are executing against their roadmap. The company closed its acquisition of Logic.io, enhancing configuration functionality. It also acquired Data.World to improve metadata governance capabilities. Additionally, ServiceNow announced an agreement to acquire Moveworks for $2.9 billion. Moveworks specializes in conversational AI, which aligns with the company's platform strategy around embedded AI. The company is expanding global partnerships with hyperscalers and systems integrators to improve international reach. Internally, ServiceNow continues to roll out AI capabilities within its own operations. Now, let's put ServiceNow's performance in context by comparing it with its industry peers. ServiceNow's 22% revenue growth outpaced Salesforce and Workday, which posted growth in the low to mid-teens. Atlassian is growing at a faster rate but from a smaller revenue base. Functionally, ServiceNow focuses on digital workflows and IT service management. In contrast, Salesforce emphasizes customer relationship management, and Workday concentrates on human capital management. Public filings show ServiceNow's positioning around orchestration, workflow automation, and vertical-specific AI applications. Next, let's examine the key risks and challenges that emerged during this quarter. The company disclosed a Department of Justice investigation involving the hiring of a former Army official. The President and Chief Operating Officer resigned as a result of the internal review. As of the latest filing, there was no recognized financial impact. Stock-based compensation totaled $969 million in the first half of 2025, equal to about 15% of total revenue. The company has committed to $4.8 billion in cloud infrastructure obligations through 2030 and $1.9 billion in data center capital expenditures through 2028. These items contribute to long-term financial obligations and affect future cost visibility. We'll now wrap up with the major takeaways from this quarter's performance. Revenue, net income, and margins improved compared to the prior year. Cash and short-term investments increased, and the company maintained a stable debt profile. Strategic acquisitions and platform expansion continued during the quarter. The company also reported material risks, including a federal investigation, leadership changes, and a high level of stock-based compensation. Long-term capital commitments were elevated due to infrastructure and data center investments. These are key metrics to monitor going forward. This concludes the Delta Debrief on ServiceNow's Q2 2025 results. This presentation is for informational purposes only and does not constitute financial advice. All comments were derived from publicly available company filings and communications. While we strive for accuracy, this debrief may contain errors or omissions. We encourage you to refer directly to the company's Form 10-Q and other official filings for complete and verified information. Always conduct your own due diligence before making any investment decisions. Thank you for listening.